Hello there, accounting enthusiasts and future money masters. Welcome back to our channel. I'm your host Ali, and today get ready to unlock the secret language of business: financial statements. Picture this: you're standing at the edge of a vast financial landscape filled with countless opportunities, exciting ventures, and potentially life-changing investments. But here's the thing: to truly conquer this landscape, you need a map, and that map comes in the form of financial statements. Financial statements are the heartbeat of any business, the secret language that whispers the stories behind the numbers. They reveal the health, the performance, and the potential of companies, allowing you to make informed decisions and capitalize on golden opportunities. But here's the best part: you don't need to be a financial wizard or have a PhD in accounting to understand these financial statements. In fact, that's why we're here. In today's video, I will walk you through the income statement, the statement of equity, the balance sheet, and the statement of cash flow. And by the end of this video, you will be able to get the big picture behind these financials and understand how they're prepared. Let's begin with the income statement. The income statement is prepared for a specific period of time. In our example, for the year ending in December 31st, 2022. The income statement main purpose is to show a company's profitability, also called the bottom line or net income. Net income is determined by simply deducting expenses from revenue generated during the year or quarter. You might think that revenue is cash received and expenses are the cash spent. Well, this is the cash-based accounting, which is not acceptable under US GAAP or IFRS. What is considered GAAP and what companies use in their reports is the accrual method of accounting, where revenues are recorded when a sale of a product or service happened, or in other words, when earned, regardless if the company received money or not. And at the same time, expenses are recorded when incurred, regardless if the company paid for these expenses or not yet. Now, when a company's revenue is less than its expenses, profitability will be negative and a net loss is reported. When revenue exceeds expenses, a net income is reported. This bottom line, or the net income, goes straight into the statement of equity, our next financial statement. The statement of owner's equity, also called statement of changes in equity, covers the same period as the income statement, and its main objective is to show why owner's equity changed during the reporting period. It starts with the beginning balance of equity or capital. We add investments and profits made during the period, and subtract withdrawals or money distributed to the owners. I want you to think of it this way. Equity is what the company owes to its owners or shareholders. If you're an investor in a business, the more money you invest, or the more profits the company generates, the more the company will owe you. And at the opposite end, if the business is losing money, or if you withdraw money from the business, this means the company will owe you less. The equity balance at the end of the reporting period, here in our example on December 31st, will go into the balance sheet, our third financial for today. Balance sheet serves as a snapshot of the company at a specific point in time. Unlike the other three financial statements, on the header of the balance sheet, we see a date and not a period of time, like a year or a quarter. This means, on this specific date, December 31st, the company reports the following assets, liabilities, and equity. Assets are everything the company owns, like cash, accounts receivable, property, plant, equipment, and so on. Liabilities are what the company owes to external parties, such as accounts payable, meaning debt to suppliers and vendors, or notes payable, such as loans from banks or other financial institutions. And equity, as we said previously, is what the company owes to its owners. You can think of the balance sheet as the expanded version of the accounting equation. Assets are equal to liabilities plus equity. In very simple terms, the accounting equation can be understood in the following way. Any business needs assets to exist and conduct operations. You want to start a crypto mining company. You need at least some mining equipment and some cash to cover your day-to-day operations. The only way that a business can acquire these assets is by getting them from someone and being obligated in return. This someone could be an external party, like a bank that hands you out a loan, thus liability. Or it could be you. You invest in the business, so equity. Usually, the first line item that appears under assets is cash. And since cash is king, it deserves its own financial statement, the cash flow statement. The cash flow statement covers the same period as the income statement and the statement of equity. It serves two main purposes. First, it answers what was the change in the cash balance. We can see at the bottom the net increase or decrease in cash. We add it to the cash beginning balance at the start of the reporting period, and we get the cash ending balance, which should reconcile with the cash reported under assets in the balance sheet. The second purpose of the cash flow statement, which is the most important, the cash flow statement shows the sources and uses of cash. The cash flow is divided into three categories: operating, investing, and financing activities. Cash flow from operating activities represents cash receipts from customers from the sale of goods or services and cash payments incurred while operating the business. Remember when we discussed revenues and expenses in the income statement? We said the accrual method states to record all sales regardless of cash receipt and all expenses incurred regardless of cash payment. However, here in the cash flow statement, we are interested in the cash receipts and cash disbursements only. Cash from investing activities is related to cash flows from acquiring or selling fixed assets like property, land, equipment, and so on. And by the way, when I say flow, I mean both inflow and outflow of cash. Finally, cash from financing activities. These are cash flows from borrowing money, such as a cash inflow from a bank loan or raising new investments, like when companies sell shares or common stocks. That's it, guys, for financials in 8 minutes. A quick recap. The income statement shows the profitability of a company for a specific period of time, which is determined by deducting expenses from revenues. The statement of equity tracks the changes in equity. Equity is what the company owes to its owners. Investments and profits increase equity, while losses and drawings decrease equity. The balance sheet is the expanded version of the accounting equation. It shows the company's assets, liabilities, and equity at a specific point in time. Finally, the statement of cash flow displays the net change in the cash balance at the end of the reporting period. It also segregates cash flows into three categories: operating, investing, and financing activities. This video was a brief overview on the most common financials. If you want a deep dive into the world of accounting and finance and know how world-class investors and hedge fund managers read and analyze the financials, make sure to check the financial intelligence playlist on my channel. Thank you for watching and see you.